Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Hodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Hey everybody, and welcome back to Focus on Fuels. I'm Alex Hodes, and I'm here with my co-host Trevor McClanahan. How's it going, Trevor?
Good. Things have finally calmed down a little bit until today. Oil market has went sideways up until about midweek last week, and we're back into a little bit more of an uptrend here, it looks like.
Yeah, I think last time we were discussing, it was kind of hot off the presses of the Israel-Iran situation, and soon after that it seemed like the ceasefire was agreed upon. So that kind of just brought prices back down, but we have been supported here by some of the longer term moving averages. So it seems like those risks have kind of just moved to the backside of the market. And what's more, kind of taken the front, kind of the headlines now is all about, we're kind of focused more on fundamentals once again, which is a welcome sign for some in the market.
$65 a barrel on WTI was found at that was kind of that supporting point again. Mm-hmm. So interesting there. Again, we've talked about a lot on the show, but that's kind of the break-even cost for new wells in the U.S. So I think there's a little bit that has gotten into the news pretty heavily now, and I think that that's going to continue to serve as a support level just based off of that dynamic alone.
Yeah, I think it's going to be interesting. Because we do have some more decisions ahead with OPEC, right?
Yeah.
And so that's kind of, I would say, kind of a bearish tilt to the market, even though we've found support in prices. OPEC is, again, expected to increase its production.
For August for another 411, kind of sticking to that status quo of, bringing another 411,000 barrels per day back online each month. So looks like they're going to extend that into August as far as we know now. This is July 2nd. So by the time the show comes out, maybe that press news release is already out there. I think that the interesting part of that is the Saudi Arabia's point, and it looks like that they're definitely getting aggressive here. Maybe they listened to Trump's ask to some degree when they met, and it seems like that they're continuing, increasing production and keeping their foot on the gas there.
Yeah, it's almost a way to. I mean, I think they're serving themselves also. That they are benefiting from bringing more barrels back online, but they seem to be a little bit careful with regards to not tanking the market overly. And I think there will be the assessment going forward is really going to be whether demand's going to keep up with these additional barrels and how many barrels are actually being brought online. Some of the export flow data that's coming out of the Middle East in general has still not really been bringing 400,000 barrels outright. Some of the producers have kind of come in line with their production cuts, so it's kind of just a balance of what will demand actually kind of balance out this additional supply, and that's where there's been some question marks, I'd say.
Yeah, there's definitely question marks because it's kind of a little bit of a double-edged sword on that. It seems that we're seeing that demand is actually staying relatively strong right now. domestically, I'd say. And then we got the 4th of July weekend coming up now. And the Middle East is using a ton of that production that they're bringing back online domestically in their own countries with summer heating or summer cooling demand. So that obviously won't last forever, and it will be interesting to see kind of what that, as we get through the summer, what that looks like going forward. But one thing I also want to just point out is that recent price spike that we've seen actually gave a lot of the U.S. producers an opportunity to go in and hedge. And I've seen a lot of reports that there was just sample sizes of this, but they did take a lot of that opportunity and jumped on it and, hedged out their production going in through the year. I will say, though, that didn't extend too far because the market was still inverted when we did see that spike in crude. So they weren't able to go out and short those positions out in like 2026 by any means, but that still gave them opportunity to kind of produce through this year and save margins for the profit margins for the year. So may not see, it might just cause another delay in U.S. production to either plateau or fall off some as Saudi Arabia and OPEC in general look to take more market share.
Yeah, I think so. As of our last commitment of traders report, some of our analysis kind of did point out that we saw a lot more action from swap dealers reducing length, and a lot of that flow is from producer hedging. And when Trevor says the inversion of the market, that is that the front month of crude oil was elevated with respect to the rest of the curve. So, producers will take advantage of, they can't be as nimble of, if there's a huge price spike, they're not going to benefit on the back end, like right. Trevor said. So, I think there was a lot of that producer hedging that occurred.
When it got in the 70s, and it jumped on it. And then that didn't last long, as we know. But it did, while it was there, they seemed to jump on it and take advantage of it. And it just they weren't able to take as long, take a long position on that, or a short position on a long-term basis, considering, how that the time spread was looking at the time.
And I think so with that hedging in mind, it's, been an extremely volatile time, and a lot of that flow that causes those spikes, although we did see, some hedging opportunities, a lot of that flow is driven by hedge funds and CTAs that are kind of following these trends. So when I don't know if Trevor's said this online or offline, but we recently passed a longer term moving average in WTI. And so that really does incentivize more hedge funds, CTAs that are kind of those trend following traders to pile back into the market. So I think that's another factor of how we could be supported here, even when we're seeing kind of some relatively bearish news of OPEC producers kind of bringing on more barrels, and the ability now for WTI producers or just, domestic producers who are hedged up, they're maybe able to kind of be a little bit more resilient in their production. And according to our latest production model, we actually adjusted it up 100,000 barrels. So, we saw higher prices in WTI as well. And so that's a big driver. We haven't been back down in those $50 ranges. So, it's going to keep those producers a little bit more resilient than we initially thought. But I think now there is kind of that market psychological point of that $65 per barrel, $60 per barrel are areas where, the rest of the market's like, okay, well, this can't be sustainable right here. I still am thinking that the latter half of this year, I'm not expecting a gigantic rally, but we're seeing some signs of strength, particularly on the diesel front. So can you speak on a little bit about that, about where kind of diesel inventories are, what's driving diesel markets, and some things that have been going on there?
Yeah, so it kind of all started in the beginning of this year with the big winter demand season that we've seen. That drained a lot of domestic diesel inventories or distillate inventories just from home heating oil. We've talked about that again over um, throughout the podcast. And then now it leaked into the spring when we had a pretty substantial refinery turnaround season. And then right when we thought we might see some relief, when refineries started coming back online, we had the Iran-Israel conflict that globally had a pretty big bite out of the distillate pool as far as production goes on that refining. So again, it's just kind of these three different layers of impacts on the diesel market that have left us now down to on just regular non-renewable diesel inventories down to, I look back today and it was like the 15-year low on inventories there. So we've worked these inventories down substantially here, and we're seeing that even more so as we talked about on the time curve on crude. That it's even more inverted on the diesel side, and we've even seen kind of the front month keep continuing to get bid up significantly at the towards the end of the month, and that's starting to already happen this month here. So yeah, very big discounts on the back end of the curve in comparison to the front end on diesel markets. And it's making this market extremely sensitive too. So if anything happens on the supply side or on the production side, it's going to react even more, aggressively if something were to happen. So I'm kind of with you. I'm starting to get a little bit more concerned about diesel, and I think this fall, because typically what happens is seasonally we start seeing building phases during right now, and we just seen a report today from EIA that showed another 1.4 million barrel draw in diesel inventories, while every other product, had a pretty significant build. So I think, the export market's booming on the diesel side. While crack spreads are going to encourage the refineries to, go to more of a distillate side of the production cycle, it's got a lot of catching up to do. And once we get to about mid-August, we typically start seeing another drawing phase due to refinery turnarounds, and then also just with ag demand coming back in play as well. So those two factors together could make us, in a really tight spot for diesel markets, going into the fall. So I think it's a good idea for guys to go out and hedge that.
Yeah. And I think what's interesting is this is usually the time of year where we see gasoline kind of take the lead, and gasoline has really been kind of the laggard. So peak gasoline demand season tends to be around this time. The inventories are really following kind of the seasonal trends. So we temporarily usually see a brief amounts of builds in advance of the 4th of July holiday. But really where it's pronounced has just been in the price action between diesel and gasoline. So you're seeing all these prompt spreads blow out in diesel and gasoline every day. When we're having up days, we haven't really seen substantial moves on the gasoline side as pronounced as it's been on diesel. So I think that's really telling about what the market is kind of anticipating. But in advancement or in preparation for the upcoming holiday, I think gasoline's going to be kind of more of a talked about time period, as it's kind of a gauge of where demand is. The recent data, according to tax returns, and this is kind of a data point that one of our colleagues, Vincent Delaware, tends to refer to as a gauge or kind of a measure of economic strength domestically, and it's a very kind of high frequency data point. We've seen those start to kind of tick higher year over year as of just honestly last week. And it had been kind of lagging year over year prior to that. So that kind of tells me that we're going to see a little bit of a bump in gasoline demand, or just demand in general. And I think that would be another kind of bump higher for oil markets slightly. So I'm not expecting, the highest gasoline demand on record, but I'm expecting to see kind of comparable levels to 2024 and potentially a little bit higher. And so I think if we do see those numbers, which will be reported next week, that's when we're going to kind of see some more price action on the gasoline front.
Yeah. And I think a little bit of another topic that we should address is kind of the sentiment. I think that goes along with what you just said pretty well. With where inventories were, 3 or 4 weeks ago, we were severely discounted to what the current global inventories levels were, which was kind of interesting, So that was just basically a lot of the sentiment baked into the market, stating, OPEC's bringing on all these barrels, demand isn't a question with all tariff and just economic woes that that are kind of looking ahead here. So now the market, obviously, we've seen this giant rally from the Iran-Israel deal, and then now we're kind of falling back off. But we found that support level. I think it was around the 50-day moving average that WTI found some support there. And then today we just broke above the 100-day moving average at 65.73, and that seems to be holding pretty strong. So, and we rallied right through that, and really with a lot of conviction there. So I think what's pretty good to understand is that it seems like the market's not just forecasting the sentiment as much as it was, and that now it's more in line with what the fundamentals are actually representing.
Yeah, and this market's been pretty tough with regards to analyzing inventories and the market pricing structure. So
Yeah.
It's almost, and this might sound kind of backwards, but I think once we start to actually reflect and price in those inventories, perhaps that's when we're, at the other end of the spectrum of ready to turn the other way, because, we had been underpricing these for so long, and now we're, essentially fair valued with respect to some of the inventory. So it's something that you need to pay attention to with regards to, like, the market is a very forward looking market. So it's all about expectations on the ground ahead. So previously, when prices are moving higher, that's in the anticipation that there's going to be, supply shortages or strong demand or whatnot. And then once you actually see it, that's when the market's like, okay, well, what next on kind of looking ahead. So, but what's most telling of that is the oil market, the price itself. So the price itself is we're seeing some strength. Some of the spreads of WTI have also been strengthening, kind of those longer term spreads. A lot of those tend to be favored by some hedge funds or CTAs as well, that kind of move on kind of a longer term basis. They use those as kind of trade signals as well. Those have moved above longer term moving averages as well. So I think we could be set for a sideways to upward action in the near term. But I'm just not too sure about whether we're going to be touching upper 70s once again, because I think the fundamental picture is that we're still expecting kind of an oversupplied market, although it doesn't really feel that way right now.
Yeah. So for me, I'll give my last 2 cents of where I kind of think things could go next. On the short term scale for basically the end of the year, I think this, especially the diesel market's going to be hypersensitive, right? Kind of already touched on that, but I think that's going to be the one that's going to stick out the most. So I remain slightly bullish, and I just think that there's significantly more upside risk than there is downside on diesel. Whereas, and especially considering if you're going to lock in, you're locking in quite a bit lower than where the market is in the front month. So that adds some value to whatever hedgers are out there that are wanting to lock in their cost. But on the crude side, I'm with you. I think in the back end of the year, it's going to be hard. for crude to stay above really 65 bucks a barrel, or stay above 65 bucks a barrel. Because I do think it could kind of find some range bound there between 60 and 65. And going into 26, that's kind of my expectation. But short term, and we're still not out of the woods, really, in my opinion, on the Middle East situation. I'd still want to see some of the dust settle from that. So I just see there to be more short term upside risk than there is downside, in my opinion, right now. And that's a little bit of a shift in what we've been saying the last couple of weeks, as far as what our outlook was.
Mm-hmm. And I think you can see that just how reactive the market was when those Middle East tensions did flare. So that is kind of an indication of how relatively unpriced that geopolitical risk was prior to that escalation. So yeah, I think there's still some risk out there, although the ceasefire appears to be holding, but we've seen ceasefires all the time.
Right.
Yeah, it's very sensitive and it needs to be priced in accordingly. And there's still sanctions on Iran as well. But
yeah, what's your opinion on kind of the short-term outlook for yourself?
Yeah, I think all signs are pointing to moving higher, just with regards to kind of the price, like technicals, and kind of the spreads are kind of telling the story. And it's hard for me to imagine crude moving down with the spreads blowing out in diesel so much, and kind of pointing to some strength there. Obviously, it's got to reach a point at some point where it turns back the other way, but it just seems like refined products are kind of taking the lead right now, and that usually is an indication that demand's strong in the market. So I'm thinking that until we start to see kind of more of those barrels from OPEC come back online and we see things kind of cool down, because honestly, the U.S., as with regards to exports, we've kind of cooled off a little bit, and the U.S. has been kind of a really export-driven market. So even with our exports cooling a little bit, we still have been pretty supported. So it's just hard to get very bearish for me right now. But I don't think there's a super bullish story out there either. And so that tells me it's a sideways to upward market, I guess.
Yep, absolutely. Yeah, I think the only thing I'm more bearish upon is right now is propane. I mean, recently we've seen a lot of more builds, and they were delayed this year due to this kind of, I think it was because the exports have been so strong. But that's been the big factor, is a lot of big builds, really big builds too, in the last 3 or 4 weeks now. So I remain patient on propane, on locking anything there. Even with crude kind of finding a little bit of strength in the last couple days here, propane is not. It's been actually kind of trading down. So, and it's been trading down for the last couple weeks now. So sit on your hands on that one, in my opinion. And I think that, later this month or even early August will be the time to strike for locking in propane costs this year.
Yeah, and that's kind of a balance between when there's expected to be more propane export capacity coming online this month. So it's almost
and demand too, right? The PDH stuff's supposed to be coming back online this month.
Exactly. So I think you see those two things it could be a delicate balance of finding that bottom. So I think just we definitely are trending downward, but it's hard to find where that absolute bottom is. But yeah, I think that will probably do it for this week's episode. I hope everybody enjoys their upcoming 4th of July weekend. If this comes out after that, hopefully you guys all stayed safe. Nobody was playing with fireworks too aggressively or anything like that. But thank you for joining us, and just continue to follow us, and we'll be putting out special reports on kind of a monthly basis. So any topic that's of discussion, we'll try and put something out there for you. So thank you.
Thank you, guys.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX. a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.